Hey guys, how's it going? Option Sniper here with the Santarelli Exchange. So today we're going to talk about Bollinger Bands. I'm going to show you guys how I have one of my chart setups in Thinkorswim, and we're also going to talk about the market in general. If you enjoyed this video, feel free to like, subscribe to our channel, check out our website. The link is in the description. We give a free month to all new members. We're on the site. We have a chat and we have trading alerts and we have educational videos every week. So if that sounds interesting to you, please check that out. All right, so let's get into this lesson. Like I said, this lesson is going to be about, we're going to talk about Bollinger Bands. We're going to do some rules to review, which I have been trying to drive home over and over again, and I do want to cover those briefly. Not going to take a lot of time on them, but they are going to be there. And then we're going to talk about the market. So this upcoming week in the market is usually the most eventful week of the month, is the first Friday of every month. Non-farm payrolls comes out. That's kind of an economic number that the market cares about significantly more than most other economic data that comes out every month. And the big thing we're waiting on to find out this week is, when will Comey testify? There's no known date. It's just, he said after Memorial Day. If you guys don't remember, Comey is what Comey said about what Trump did with calling him and asking him to leave Flynn alone, basically. That was what caused our markets to sell off 2 weeks ago. It was the sharpest sell-off we've had in over 6 months. The S&P dropped about 40 points. So that's kind of, the market has kind of, for the short term, forgotten about that. But when Comey comes back, we should be expecting more volatility in the market. And the fact that there's no known date for that makes it kind of a even more risky unknown hanging over the market, because obviously we saw what he did the first time when he just claimed that Trump did that. Well, if he actually testifies and, goes under oath and talks about it even more, obviously that has the potential to cause more volatility. So as soon as we find out the date for that, we will make sure we let everybody know. I don't know when it's going to happen. I was thinking it was supposed to be a week ago. That they changed that quickly. So, it's just a lot of chatter going on with no real date at this point. So Bollinger Bands are a great tool for all traders to use, because it can be used in a couple different ways. It's always used as a measure of volatility. When the bands widen out, that means volatility is greater. And when the bands constrict and tighten, that means volatility has decreased in whatever asset you're looking at, whether it's, stocks, commodities. We use it mainly on stocks, but we do trade, gold and other types of commodities here and there. So it's a great tool to measure volatility. Why is it important to measure volatility? Well, we're trading options, and obviously the way options are priced, volatility is a huge component of how options are priced and how expensive or cheap they will be. And even on intraday, there's periods of the time of the day where volatility is higher at some periods and lower at other periods, which as option traders is very important for us to know, because we want to, if we're trading options and buying options, we obviously want to be buying when volatility is at its lowest. This will, other things being equal, this means we're buying when the options are cheaper, and we want to be looking to sell when volatility is more elevated. So yeah, this is a very good tool to measure volatility. Okay, that's one of the good benefits of the Bollinger Bands. It's also a mean reversion tool, meaning using the bands, you're able to identify when a stock is overextended in either direction. When it's touching up against the bands, that means it's overextended in that direction. And usually you can expect the stock to come back towards the 20 SMA, which is the middle line in the Bollinger Bands. We'll take a look here. I'll give you guys an example, but I just want to review it first, on this slide, kind of talk about it a little, and then we'll go and dive into an example. But basically, within the Bollinger Bands, the way that it defaults is there's a 20 simple moving average, which is the middle line, and then the bands are 2 standard deviations in both directions from the 20 simple moving average, from the 20 SMA. So yeah, when price goes and touches the bands in either direction, that's meaning it's 2 standard deviations from the 20 SMA, meaning it's moved largely in one direction. That's when you can expect it to eventually come back towards the middle line, which is the 20 SMA that it defaults to. So it's a good mean reversion tool if you're in a market that is non-trending. Okay, so right now is actually a newer cycle in the market, right? We just went through a period where we went 13 weeks straight in a non-trending, choppy market. It finally looks like we're going to start trending higher again. This was the first week ever that we closed above 2,400 on the weekly time frame. So we're at all-time highs. The S&P is at all-time highs. What we need to see is more breadth, meaning more participation, okay? We need to see small caps. We definitely need to see small caps start breaking out and trending higher with the rest of the market. We'd like to see transports do that as well, and we'd also like to see biotech. Those are kind of the more lagging industries, more specifically small caps and transports. Definitely want to see those pick up, which will help the market make an even stronger trend to the upside. But with that being said, the Bollinger Bands can be used as a mean reversion tool when the market is in a non-trending cycle. So the past 12 to 13 weeks, this was a great tool for traders to use, knowing that anytime a stock got overextended in either direction, it was more likely it was going to mean revert and come back to the middle and move in the opposite direction because we're in a chop cycle where there's no real trend. So what that means basically is when price goes too high, you can expect it to come back down, and when price goes too low, you can expect it to go back up because we're just in a chop cycle where stocks are just not trending and just chopping back and forth up and down. Now, in a trending market, the Bollinger Bands are also good. You can use them differently, but it's still a great tool to use where you want to be buying into the trend when the stock is pulling back to the middle of the Bollinger Bands, to the 20 SMA area. That's when you want to be entering the trend. So let's take a look here at a couple examples, and I'll show you guys what I have on my chart in Thinkorswim and show you how it's set up, and hopefully that can help some people, get a good handle on some good signals to help themselves with. So, okay, this is just a picture of the chart before we go into the platform. This is what the Bollinger Bands look like on my chart. Okay, you can customize them any way you want. I've made the 20 SMA, which is the middle of the Bollinger Bands. I've made it light blue, and I've made the bands on both sides dark blue. Okay, so this light blue line is just the 20 SMA. That's what this is. These two Bollinger Bands on both sides, this is a 2 standard deviation move above the 20 SMA, and this is a 2 standard deviation move below the 20 SMA. So as you can see here, the IWM has been in a chop cycle for, since this year started pretty much. So that's been almost 5 months now, right? Yeah, almost 5 full months that the IWM has been not trending, just chopping back and forth. So the best way to use the Bollinger Bands on something that is not trending, like I said, is to play it for mean reversion. So what you see here, when we saw the IWM come up towards the top of this band and stay at the top of this band, this would have been at some point a decent time to look to make a bearish trade, assuming that it's going to come back down in the other direction, which it eventually did. Now, it's hard to predict by just using the Bollinger Bands, but I do have a couple other tools on here that are pretty good tools, especially for beginners, that would help identify when you want to play the move to the opposite direction. So we got these two moving averages is the person's pivot. Whenever they cross, you get an arrow. So here's a nice signal, and then this is the TTM squeeze. As we could see, okay, yeah, we're very overextended up here, and at some point, we're going to expect the IWM to come back towards the middle of the band, at least, and probably even more likely to the bottom of the band because it's non-trending, just chopping up and down. So here was kind of a good signal. Person's pivots gave a bearish signal, right? The cross happened with the yellow below the blue, these little two moving averages, that's part of the person's pivots. And then this arrow happened that's saying, good time to short. And then also we had a bearish cross in the TTM squeeze where it went from positive to negative. So all the signals lined up, and it would have been a pretty decent bearish trade. These are 2-hour candles. They are intraday, but 2-hour candles is a really good time frame for traders at the San Diego Exchange to use, because we're swing traders. We hold our positions overnight, and so we don't want candles that are way too short in time frame. We're not day trading. We're swing trading. We're holding positions anywhere from a couple days to a couple weeks. But the 2-hour time frame is reactive enough that it allows you to get a good picture of the market that you otherwise wouldn't be able to get if you were looking at a daily candlestick. So yeah, I really like this time frame for swing trading and for the San Diego Exchange strategy and purposes. I think the 2-hour time frame on candles is a really good time frame for all traders to be using. And even if you're like myself, where obviously I'm doing things on my own, I still think that the 2-hour time frame is a very good time frame to look at no matter what, just because it's not so reactive and volatile that you get like false signals, and you just get a better picture. So the longer time period on the candles, the better picture that you get, the easier it is to see the actual trend. Whereas if you say you're using 10-minute, 5-minute, 1-minute candles, there's going to be a lot of noise, right? It's going to be harder to see the overall picture because there's a lot of noise during the day. There's, prices are moving, candles are being created, prices moving up and down. It's really the main thing that you need to do as a trader, and even more importantly, even as an options trader, is you have to disseminate between the noise and the actual movements that matter, okay? And by using shorter time frame candles, that is a lot more difficult to do, especially for a beginner. So as a beginner, you really want to make sure you're using longer term candles because it's easier to disseminate between noise and actual meaningful price movements, okay? And there's a lot of noise in the market. There's intraday, it's a majority of price fluctuations is just noise, okay? So having the ability to disseminate between that, it should be one of the main goals of everybody when they're starting out in the market. So that's why I like the 2-hour time frame. But what we saw here is, like I said, the IWM has been in a mean reverting non-trending cycle, still is. And so what we're looking for with the Bollinger Bands in a non-trending stock is to play mean reversion, meaning when it gets to the top of the bands, we want to look to be ready to short it, assuming that it's going to come back in the other direction, which is exactly what it did. And then we had down here another extreme where this would have been a good opportunity to try to enter a bullish trade, assuming that it's going to come back in the other direction, which it did. And obviously, it would be much more difficult to use the Bollinger Bands by themselves. So there are a couple more tools on here. Now, the other thing that I did mention on the slides that you can see here as well is when volatility is increasing, the bands are widening, right? So you see how wide the bands got here? When the IWM was rallying strong, these bands widen out. That signals volatility is increasing, okay? Volatility is an option trader's best friend. So that's good to see if you're actually in the position now. This is not the time to be looking to enter, in my opinion, when volatility is heightened. Here, okay, do you see? We can see here how narrow these bands are. This is saying volatility is a lot lower, okay? These are the time periods as options traders where we want to be looking to enter and buy at these types of periods because volatility is lower, meaning the price of the options, all things being equal, is going to be lower, okay? And then And then, when it picks back up again, we see the bands widen again when the IWM gap down. And volatility just goes in cycles, right? So as options traders, yeah, it's good to be trading when these bands are wider, okay, if you want to be more active. And if you're swing trading, it's really better to be buying into your positions when volatility is lower, okay, when these bands are more narrow. So yeah, I mean, Bollinger Band's a great tool. I have them on most of my charts. I have the Bollinger Bands, especially on the IWM, because it's just always mean reverting. It's bouncing back and forth. But on all stocks too, because when you're entering a trend, you never want to be. When you're entering a trend, let's say the IWM's in a bullish trend, we never want to be entering into this bullish trend when the IWM is pushing up against these top bands. Okay, if we're looking to enter a trend trade, we would be using this and saying, okay, I want to wait until it comes back into the middle to enter a bullish trade, right? So, and same idea with the other direction as well, moving down. You wouldn't want to short here, okay? If I'm looking to try and get a bearish position, I don't want to be shorting down here, okay? That's like, if you're looking to actually buy at the worst possible time or short at the worst possible time, this would be the place to do it, okay? And that happens sometimes with newer traders. They'll enter into a trade at the completely wrong time, assuming that something's going to continue to go in the same direction. Well, that's a mistake in and of itself, because as I've already emphasized, the past 12 weeks, the market was going nowhere. Okay, so if you were entering a trade the past 12 weeks, assuming something was going to keep going in the same direction, you probably lost some money, because that's not what was happening, right? You should, in a non-trending cycle, you should be looking to fade any movement, right? So what I mean by that is if we're extreme to the downside and we're on these bands, you should be looking to trade in the other direction, right? Look for a bullish setup here. If we're on the top of these bands, extreme to the upside, you should be looking to fade that and try to look for a short opportunity, assuming that we're going to come back in the other direction, which is exactly what's been happening, okay? So I'm going to exit out of this and we'll go into my platform. I'll show you guys these tools and I'll check for any questions. All right, I don't see any questions, so I will keep going. So this is actually my platform, right? Here we go up here into studies, edit studies. So what do I have here? You can type in anything. So I have the PPS, which is person's pivots. That's these lines and these arrows. Okay, I have the Bollinger Bands. The 20 simple moving average and the 2 standard deviations. That's what that defaults to. And then I have the TTM squeeze, which just all on default settings. Okay, so that's what I got there for my studies. And even to me, I'm not big on studies. I like just reading price action. But this is, in my opinion, borderline too many studies. And there's not even that many, right? There's only 3. But I don't like a lot of things on my chart. I just like to see price. So, because price is what matters. All these indicators are deriving themselves based off past price action, okay? No indicator is forward looking. It's making itself based off prices that occurred, obviously, in the past. So that's why indicators, while they can definitely help newer traders, the goal should be to minimize, to keep it simple. The goal should be to not have to use any indicators and just look at price. Okay, now I think the Bollinger Bands are so important because volatility really matters, especially for options traders. So I would say if there's going to be one tool to use as an options trader, it's probably Bollinger Bands. But these other tools that I have here, I think, complement Bollinger Bands. So I think this is a really good system for a newer trader. You line these 3 things up, knowing how the market is, what kind of cycle the market is in, and you can trade that accordingly with these tools. So those are the studies I have. You see here I have 2-hour candles, okay, and 180 days 2-hour candles, and that's basically everything here. Now, the one thing I do want to show is this chart's obviously zoomed in. Now, when you have a chart zoomed in, it's harder to get the overall picture, okay? You should always start with the chart, the biggest picture you can get. That's going to help give you a better idea of the overall trend of the market, and then once you have that, you trade that accordingly, okay? Sometimes I myself will sometimes even, I've done it in the past, I don't do it as much anymore, and a mistake that I see, a lot of beginners make is they fail to understand the overall trend and cycle, right? They'll get so caught up right in here that they won't realize what's actually going on, okay? You can't really, if you're looking at a very small amount of candles, it's really hard to get the overall picture of the market. Like what is this? I mean, if you were, let's say if you were zoomed in here, you could argue, oh, we're in an uptrend, but we're definitely not in an uptrend, right? I mean, we had this Trump rally, right? Not in the small caps IWM. We had this huge Trump rally when he got elected, and we haven't the small caps haven't gone anywhere since, December. Okay, so we've been in a very tight range, and the obvious clear trend of small caps at this moment is chop. No trend. Okay, this is where there's no trend right now. We've been chopping back and forth for actually even more than 5 months, almost 6 months. But the one thing I will say is when you see price consolidate, you should always look to the previous big move to assume where the next big move will be. Okay, meaning look at this consolidation. Where was the last big move we had? The last big move we had was up. So after this consolidation, it's more likely that the next big move we have will also be up. So that's also important to keep in mind as well. And the overall, this is the small caps, right? So you don't start with the small caps. You should always start with the S&P, the SPY. So obviously the S&P and the Dow are a lot different. They look stronger, okay? And we are at all-time highs on the S&P. So the overall market is actually starting to trend up. It's starting to trend higher. But if we actually get participation in the small caps, that will allow this uptrend to be much, much stronger, and will probably go much further. We need more participation. But as we can see, even the S&P, it's been pretty weakly uptrending. Okay, it wasn't, like I said, it wasn't trending for a long time, right? Where are we in March? Okay, we made that little move up in March, and then since the beginning of March, we didn't go anywhere. And now we finally closed above 2,400. But these are just examples of how important it is to get the overall picture of the market before you actually dive in and start trying to trade, because you need to have the overall picture. Okay, so that's very important. So what else here? I guess we can look at a couple charts like Amazon. Big tech has really been so strong. It's been a lot stronger than everything else. So that's a good sign, but they can only carry the market so far. We need more participation, but obviously Amazon's just been in a very strong uptrend. Okay, and there's no reason why that shouldn't continue, assuming the market continues trending higher. Big tech has really been the most dominant participating force in this market here in 2017. And there's really no reason why that shouldn't continue. And we can see here, using Amazon as an example, it did get overextended up here towards the top of the bands, but then it pulled back. So this could be a decent time to look at bullish entries. If you're really looking to time it well, you'd want to see it come back down into here. But it might not do that because it's been so strong. So it has, chopped around long enough to be a better entry. This would have been, obviously, when it's up against the band, that's the worst possible time. And now that it's inside the bands a little bit more, it's a lot more attractive than it was previously. So yeah, I mean, Amazon's been a beast. Now I've been looking at some other names as well, like Snap. Snap on last Thursday rallied like 6%. On Friday, this was, where are we at? So Friday didn't do much. Yeah, Snap didn't do much on Friday, which was kind of disappointing because it went up so much on Thursday. I thought that there would be some follow through, which didn't happen on Friday, but that doesn't mean it's not going to happen this week. I would expect there to be follow through in Snap after Thursday's move. Now it did move down a lot on Friday, but it's flat. It's still flagging, and that's obviously not as easy to see on 2-hour candles. But this is my system. Just wanted to show this to you guys. My favorite charts to use is just stock charts. It's such a simple picture, and obviously I use daily candles are what you should be using for your main analysis, right? And then when you're looking to enter trades, I'd say 2-hour candles probably will give you a better kind of zoomed in look and probably a better tool to look for entries when using the Santarelli exchange and trying to trade our strategies. 2-hour candle is probably a better way to look for setups to enter. But I think that even before doing this probably wasn't the best order, but I wanted to teach this new concept. But even before doing this, you should be starting off with your daily candlesticks, and then you drill down into 2-hour candles, okay? Now, these are money management rules. I don't really need to, I've talked about these plenty of times. I just want to, this weekly thing here, I just want to keep, driving this home because it's so important, guys. I don't think some people understand how risky it is to hold weekly options overnight in your account. It's very possible that you will lose whatever you put into those weeklies if the trade doesn't work. It's probably, if the trade doesn't work, you're very much going to lose whatever you put into that. Okay, so don't hold a lot of your account in weeklies, please. I think there's still too many people getting too aggressive with that. So make sure, I would say 3% is ideal, okay? I wouldn't go over 5% of your account in weeklies, holding overnight, okay? Just holding overnight weeklies is, you can really hurt yourself if the market moves against you. So I want to see everybody protect themselves. And then I say, 3%, greater than 7 days, less than 30 days expiration, and then 5% out 30 plus days in expiration, okay? But with this one, you can put 10%, and assume that you're only risking 5% if you're going out 30 plus days. So just a quick review of that. Beginner's Guide to Success. Basically, be disciplined, be patient, pick your spots, okay? If you're subject to the pattern day trading rule, use that to your advantage, meaning be selective, okay? You can make the pattern day trading rule work in your advantage if you so choose. I would say it's best to definitely don't do much on Monday. The first trading day of the week, I don't like to do much at all. Even the second trading day of the week. Usually Monday and Tuesday, I don't do much at all. I like seeing, what's going on, what the market's doing. And then as we get later to the week, I see a clearer picture, right? So Monday especially, Tuesday, I don't really get that aggressive. I always start the week out slow. I think it's best to start the week out slow. Okay? And don't hold a lot, obviously, weeklies overnight in your account, please. And identify the overall trend. That's always important. So be patient, be disciplined, and you will set yourself up for success. Okay, so now we're gonna look here. There was one other thing I wanted to, what was it? Yeah, okay. So let's see if anybody has any questions. I don't see any questions, so we'll keep going. So now, obviously I was just thinking about how I was just showing you guys 2-hour candles And that's like the last place you want to go, right? After looking at the end of every week, you should be looking at weekly candles and then daily candles and then the 2 hour once you understand the actual picture of the market by using those longer term time frames. But I thought, using the 2 hours is important to show kind of that system that I think people can make work for themselves somewhat easily by using the right approach and being disciplined. Okay, so this right here, what do we see? This is the weekly chart of the S&P 500. Okay, this is where all analysis should always start, in my opinion, on the S&P 500. And at the end of every week, look at the weekly candles. And even at the end of every month, you could look at monthly candles. And always using daily candles every day. So what we saw last week was the first time ever that the S&P was able to close above 2,400 on the weekly time frame. We closed above the previous week's high. Okay, so on the weekly time frame here, we could be just getting started, right? You see what happened here when we were actually trending. We went 6 straight weeks where we closed above the previous week's high. Well, almost 6 straight. We didn't close above the previous week's high here, but close enough. We went through a 6-week time frame where we trended up, okay? Here as well. So, with all that, this could actually be week 1, and it's possible we could get, 3 or 4 more weeks of just upward price action. Nice upward trending market, which we haven't had in a long time. So this has been a tougher market for a lot of people, okay? Now, this is the time period where if we start trending, everybody should be making nice profits. And we saw that last week, with Amazon and some other trades that we made in the chat and at the San Diego Exchange. We did have a pretty good week last week because we started trending again, right? We see here this long wick to the downside, put in a bottom. This was Wednesday's, what happened the Wednesday, right? When that stuff came out about Comey, we had that 1-day sell-off, bounced. Now we're back above 2,400 and looking like we can start trending higher. Looking like we can probably come in the next 3 or 4 or 5 weeks and test 2,500. Okay, that's probably where we can go. We can head to 2,500, assuming everything stays smooth. So this does look to be the beginning of a new short-term uptrend after we went 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 weeks of not going anywhere. And now this finally closed above the previous week's high, closed at all-time highs, and looking like we can start trending higher. Now, on the daily, this is the daily time frame on the S&P, okay? Now, on the daily time frame, it is a little bit overextended, but that doesn't mean it can't continue higher. But we should expect that there's going to be at least a couple days of sideways to small downwards moves this week. I mean, there should be I would expect there to be a little bit of weakness this week at some point, just because on the daily time frame we are pretty overextended, right? 1, 2, 3, 4, 5, 6. 6 days in a row of closing above the previous day's high, where we went from 2350 to 2415, so 65 points. This is a little bit overdone. A nice healthy test would be 2,400. Nice healthy entry of this new trend would be between like 2,400 and 2,405 would be a good place to enter this new trending move, assuming that the trend continues. Okay, and now obviously the next point of resistance is going to be 2,420, where we made this high on Thursday. So yeah, things are looking good on the S&P for sure, but we do want to see more participation. Okay, and that was the other thing I wanted to look at. I wanted to look at the IWM and show you guys that as well, which is on here. So, this is this week's economic calendar. Like I said here, this is really the big thing. Okay, first Friday of every month is non-farm payrolls. We get what the unemployment rate is, we get how many jobs were added for the previous month, and it's the most important, economic data point of the month, usually. And it does have the potential to move the market more so than anything else. Okay. Now, I have these highlighted because you always should be aware of it when anyone from the Fed is speaking. They always have the potential. Usually nothing comes of it, Probably I would say 90 to 95% of the time. Fed speakers don't really have an impact on the market, but every once in a while they do. And, the Fed is really in control of our market. So just, thing to be aware of. And then rig count, because rig counts have been rising here for a long time. And we saw last week oil had a pretty big move downwards after OPEC didn't agree to any additional cuts. That's what caused that. But really, rig count is always interesting to see because I don't think the market, based off of what we've seen in the past, the market does not like seeing oil go too far down. Okay. Seeing oil tanking is usually not good for the market. The market doesn't like that. Okay. So that's just something to be aware of. Stocks. So our stocks that we have, on the watch list, can share this in the chat. I'll post a link to the slides in our chat. But here's what we're watching. A lot of us are watching. This is what I'm watching as well. I'm interested to see what Snap does this week because of that big move on Thursday. And some of these names here, I recently added these. These are pretty interesting charts. And yeah, CMG was a mover a couple weeks ago, but it's been kind of dead here this past week and a half. So we'll keep an eye on that. I want to see CMG get above 490. And, we are trading a lot of these stocks. When it did look better last week. Let's take a look here at... I wanted to look at the IWM. So you could see, just like in the last chart, it has been chopping for a while. And we really want to see the IWM break out and get back above 141 to help, the overall market start trending higher and increase the strength of the actual bullish trend. We need to see small caps participate and break out as well. So we saw, S&P's breaking out, the Dow's breaking out, QQQ, which is NASDAQ 100, big tech, that's continuing to make all-time highs, breaking out. But we need to see participation in small caps. We need to also see participation in transports, which is the IYT. Can look at that real quick. So yeah, IYT looks a little bit better, but it's still not making highs, and we would like to see that. Whereas you can see QQQ obviously continuing to make all-time highs, higher highs, straight up. This is the NASDAQ 100, so the 100 biggest tech names, just obviously clear strength, right? I mean, this is just insane strength. So yeah, that's kind of what's been leading the market, right? And then the SPY, S&P ETF, also all-time highs, and then DIA, Dow ETF, also all-time highs close. Actually, I realized recently, I don't know when this happened, I don't know how long it's been like this, but there is actually more tech stocks in the Dow than I thought. I just recently looked up the holdings of some of these ETFs and indexes actually to see, so I was looking at new names in the IWM, so I looked up the holdings in there to find some good, mid-sized to smaller size companies to trade options on. But what I did see when I looked at the DIA, obviously there's only 30 names in it. So it's just, the Dow ETF. But I was surprised to see Facebook, Amazon, Google. Facebook, Amazon, and Google are all in the Dow, which was interesting. I didn't realize, when I think of the Dow, I picture like stocks that don't really have any growth, slower, more safer. They pay dividends, But it was interesting to see that Amazon and Google and Facebook are actually in the Dow. But, they are big companies, so it makes sense. I just never thought of them actually being in. So they're in all the indexes pretty much. They're in the QQQ, they're in the SPY. Obviously, they're not in the IWM, but that was something interesting that I actually learned recently. So figured I'd share it. Let's see here. Okay, so now one other thing I wanted to look at is I just want to look at commodities, because commodities have been going crazy here these past couple weeks, especially Bitcoin. Okay, it's just insane. But as we can see, oil, right? So oil had that big move down because of OPEC. The street was mad that OPEC didn't cut more production, but had a little bit of a retracement on Friday. But, we don't want to see oil come back down around here. That's probably not good. We want to see it hold 45, even better if it holds 47. The lower it gets, if it comes back down through 44 and down here, the market's not going to like that. So we'd like to see it ideally stay above 50 in this range up here. If we're bulls and we want to see the market continue trending higher. Now, there's been some kind of mixed signals, even though we've been making all-time highs. Gold and bonds have both been rallying as well, meaning when bonds rally, rates go lower. That's kind of seen as more bearish. And when gold moves up, that's also seen as, there's some more kind of insecurity, I guess, or fear in the market when gold is rallying. So normally wouldn't expect to see gold and bonds rallying when the market's at all-time highs. So that's just something that we should also be aware of. Normally you expect to see rates going higher and bonds selling off and gold down to flat when we're making all-time highs in the market, but that's not the case right now. So I just wanted to point this out because it's interesting what we're seeing here. We're seeing, kind of mixed signals in the market where when gold's rallying, usually that's not as bullish for the market. So, and also this chart is a great example of the golden cross. Okay, the golden cross is when the 50 SMA crosses above the 200 SMA. That's a bullish cross, right? A bullish golden cross. So that is just happening on gold. And gold looks to just be starting, possibly could be starting a new uptrend. Needs to hold 1220 to the downside. And even more importantly, at least the 200 SMA. If it gets below 200 SMA, then it's probably going to test 1220. If it doesn't hold there, then this could potentially be a head and shoulders. It's tough to say. I feel like gold's in a position right now where it could go in either direction. But it is unusual to see gold this strong with where the market is. And obviously, Bitcoin, this is just an example of a market that's going insane. There's a lot of money in Japan going into Bitcoin, but one Bitcoin is now worth way more than an ounce of gold, which is interesting. And there's definitely a lot of money going to Bitcoin. So that's another signal here, like, just makes me wonder, why is so much money in Japan and Asia going into Bitcoin? What do they know? Like, do they know something that most people don't know? It's just gone parabolic here, these past couple months. So something to be aware of, because it's really going crazy. So it makes me question, is there something, what's going on? This is just crazy. Maybe something is, maybe something's not, but it's clear that there's a lot of money going to Bitcoin. And the main thing for me is that I don't like to miss out on, opportunities, and I definitely missed out on this, which is unfortunate, but I want to use it as an example of how important it is to be aware of all markets, right? Because people are, Bitcoin's making people millionaires right now. It's obviously going crazy. At some point, it's going to crash just as fast as it has risen. But if you actually played it smart, you could definitely have made ridiculous amounts of money, right? I mean, the past year it was at 400 like a year ago, and now it's gotten all the way up to almost 2,800. So, it's definitely made people millionaires, and it's definitely the craziest, most volatile market right now is Bitcoin. So, something we need to be in my opinion, you need to be aware of all markets because everything to a certain extent has correlation, right? So yeah, it's you never just want to have the blinders on. You want to be aware of the whole picture here. And like I said, these are bonds, right? TLTs, the 20 plus year bond ETF. As we can see, TLT is actually looking like it's starting an uptrend here, a little bit holding the 50 SMA above the 50 SMA. And when bonds move higher, rates go lower, and when rates are going lower, this is basically meaning money is going into bonds. So when you see money go into bonds and gold, and you see the market at all-time highs, it's kind of like mixed signals. Like, basically need to ask ourselves, why is there so much money going into gold and bonds? Why, if the market's at all-time highs, shouldn't that money be going into the market? So yeah, that's why you usually don't see TLT, GLD, or gold. GLD is an ETF for gold. You usually don't see TLT, gold, and the S&P, or you can just say usually don't see bonds, gold, and the S&P all moving up together. It's not normal. It's not normal for the market, but there will be time periods where that will happen, and this is one of them. But it's just something to be aware of. And we already looked at the IWM, so that's everything I wanted to look at for today and teach you guys. Yeah, Jorge manages Ethereum, or Jorge mentions Ethereum. Ethereum is also another one that I was looking at here, and that has also gone kind of parabolic as well. So yeah, I mean, Bitcoin and Ethereum have been going crazy here. So definitely something for us to be aware of. And does anybody have any questions before we end this session? Okay, I don't see any questions. During the week, I'm in the chat every morning from 8:30. No, I'm sorry, from 7:30 to 8:30 Eastern. So I'm on Pacific time, so for me it's 4:30, 5:30. So yeah, every morning during the week, I'm in the chat for an hour. Feel free to ask me any questions and use me as much as you want. Happy to help you guys with anything. And that's going to be it for today. Glad I was able to show you guys this new stuff. If you're just coming in now, I think it was a pretty good session. We went over Bollinger Bands and some key things in the market. So I'm going to end this with saying we need to be aware of when Comey is testifying, okay? Because that has the potential to really move the market. So as soon as I see a date for that, I'll make sure I share that with everybody in the chat. But that's kind of the thing that's hanging over the market's head is when and if Comey's going to testify. Because obviously we saw what happened to the market 2 weeks ago when it dropped, when the S&P dropped like 40 points in a day. So yeah, we need to be aware of that. And that's going to be everything for today. Enjoy the rest of your Memorial Day, guys. And I'll see you everybody in chat tomorrow morning.